Understanding the Indian budget. This comes under the fiscal policy, which is completely different from the monetary policy. In this video, we explain the key parameters that investors and traders must observe and interpret in the union budget. Key policies made in areas like capital expenditure, current government spending, direct taxes, indirect taxes, taxes on capital gains, and revenue expenditures. These are the primary factors which influence the investors. So we made this video particularly in the investor's point of view so that they can observe where the money is flowing and invest in the sectors which can benefit them by making profits. Hi, welcome to PSI, Plan, Save and Invest. First, let us understand the total revenues to the Indian government, from where these revenues are accumulated. So if you see the tabular form, revenue receipts in crores. First, the corporate tax, which is approximately 10,20,000 crore and it's contributing 17% to the total revenue. Next, direct taxes on personal income. This is charged on the individuals. This is approximately 11,87,000 crore and it is contributing 20% on the total revenue. So this is the long debate now running in the market, because direct taxes on individuals on personal income is more than corporate tax. So, there is a lot of debate like why, individuals and middle class people are being taxed so much, which is crossing more than corporate tax. Okay, that's debate apart. But coming to the other revenues, customs 2,37,745 crores contributing 4%, union excise duties 3,19,000 crore 5% contribution, GST 10,61,899 crore which is contributing 18%. So if you observe the revenues, corporate tax, direct tax and GST, these three are the key parameters of or primary income to the Indian government. After adding all the revenues, the budget is coming approximately 59 lakh crores, that is 6,786. Now the revenue distributed to all 29 states, that is approximately 12,56,671 crores, which is approximately 21% of the total budget. So the net budget amount available for the Indian government to spend in the following year is 46,80,115 crores. So let us see in what areas finance minister planned to distribute this amount and spend this amount, and let us focus primarily on in investor point of view, how we can benefit observing the budget. Let us observe the key parameters which are useful for the investors. The number one is capital expenditure. Capital expenditure is completely different from the revenue expenditure. Capital expenditure is like you expend some X amount of money so that you will get returns by investing this X amount in businesses or in other areas, and you will yield some returns in the future date. So capital expenditure, there is a return on it. So as an investor, we should be primarily focused on capital expenditure. Whereas revenue expenditure, it is completely different. Revenue expenditure, welfare schemes or populist budgets. So there is no returns and it is just an expenditure. But that is expended in the point of welfare schemes. So for us, as an investor or a trader, to me, the capital expenditure is the primary area which I look in the annual budgets. So capital expenditure is the key parameter that all traders and investors should consider in the Indian annual budget. It provides a roadmap for significant money flow in the country, which can give a broader picture of which sector to invest in. For instance, the rapid growth in the Indian economy over the past 3 years has been majorly contributed by public infrastructure spending as capex. This is evident in the Indian markets bullish post-COVID. Now, India's ambition plan calls for spending India planned to spend approximately $1.723 trillion. This is approximately 143 lakh crores. So infrastructure spending. So if you observe in the current budget, the finance minister announced the continuation of capex of rupees 11 lakh crores, which is a good scenario for the Indian economy. Because so far everybody is concerned whether the current government will continue the capex which is done past 2-3 years. So a finance minister confirmed that it is going to continue the capital expenditure, but it raised the concern over private expenditure as well. So only government should not expend, but also private companies should also expend. So that is what they are trying to tell. If only government do the expenditure, then it will raise the inflation, which can cause a serious concerns in the economy in the future date. So when public expenditure, government expenditure is rising, parallelly private expenditure also should contribute to the economy. Else the inflation can rise and impact the overall economy. So if you look at the 2023 annual budget expenditure, 8% of total income is allocated to the defense sector. Because of this expenditure, you can see stocks like Hindustan Aeronauticals, Bharat Heavy Electricals Limited, that is BHEL, and BEL. All these companies rallied, almost double or triple within span of 2 years. So as an investor, we should observe where government is going to expend. So if you see in this current budget, they primarily focused on against the same infrastructure like power, roads, renewable energy, electrical vehicles. So this is the importance of capital expenditure. Next one is current government spendings. So this current government spending will not impact instantly. This current government spendings will help the economy in the future date. So let us observe what are these current government spendings. The government spends this money to generate long-term benefits such as human resource development, skill development and labor productivity in health, education and defense. For example, in FY 2024 and 2025, that is current budget, the government allocated rupees 2 lakh crores to employ 4.1 crores of youth. If you look at the where India spends pie chart, central sector schemes around 17% is allocated in the overall budget. Only some of these schemes support economic development in the long term. As an investor, we should understand that this will promote economic growth in the long term. Suppose if the employment rate is increased, which means unemployment rate is decreased, then purchasing power of the citizens will increase, which will impact the consumption and which is very good for the overall economy and stock markets as well. Whereas capital expenditures can show the impact instantly in the stock markets. Whereas current government spendings will not show the impact in the Indian markets immediately, instantly. But over a period of time it will show, because the amount allocated using current government spendings will affect all the overall sectors in human resource development. Now the third one, direct taxes. This is very important. We all know about these taxes because most of us must file ITR annually. These include income tax paid by employees, wealth tax paid by high net worth individuals and corporate tax paid by firms and corporates. Corporate tax and individual tax and wealth tax, all these are like direct taxes which is directly applicable on individuals and non-individuals. In the current budget, there is no much changes to the corporate tax, but they gave major benefits to taxpayers, particularly salaried employees. So if you see that a standard deduction was increased from rupees 50,000 to rupees 75,000. Income tax is exempted for citizens with an annual income up to rupees 5 lakhs, which is there from past few years. For citizens with income above 5 lakhs, the gross income above 5 lakhs, then the slab rates are as follows. 0 to 3 lakhs, there is no tax. 3 to 7 lakhs, 5% in current budget. In previous budget, it is 3 to 5 lakhs. So there is a benefit approximately 2 lakhs. Again, from 7 lakhs to 10 lakhs, 10%. Old regime, it is from 5 lakhs to 10 lakhs. So there is again a benefit here. 10 lakhs to 12 lakhs, 15%. There is no change from previous to current budget. 12 lakhs to 15 lakhs, 15%, no change. Above 15 lakhs, flat 30%. This is also unchanged. But if you observe, if anyone who is earning income around 15 lakhs per annum, he or she will pay approximately 1,50,000 as a tax. And we can see that there are considerable benefits to salaried employees under 15 lakhs gross income annually. The finance minister claims salaried employees can save up to rupees 17,500 annually from the tax. This cut in personal income tax aims to raise disposal income. This will increase the savings of individuals. So which will help, in their spending and, and it will support the consumption as well. So there are no corporate tax changes, but they reduced corporate tax for foreign companies from 40% to 35%. So there is a reduction of 5%. This is to ensure that, India compete with China market. So it is not like, they gave a major benefit. If there is any reduction in corporate tax to the Indian companies, then the market would have been responded very aggressively and, we would have made a lot of profits, because any change, any minute or minimal reduction in the corporate tax for Indian companies will directly impact the stock markets. Instantly you can see, a bullish spike in the Indian markets. Now coming back to indirect taxes. These taxes are paid on goods and services purchased, such as excise duty, custom duty and GST. These are easy to manage. There is no cost for Indian government to do changes in indirect taxes. GST has been painful to many citizens in India so far. 18% GST is not justifiable when citizens are paying 30% tax above 15 lakhs. So the government has taken relief measures cutting the GST rate on many goods and services. The cut in indirect taxes can raise the actual income and boost aggregate demand and consumption. Okay, these are the benefits so far. Finance minister clearly told that, they want to reduce the GST. So we should wait and see, when they are going to implement these measures. Now, tax increased in other revenue receipts, long-term capital gains, short-term capital gains, and securities transaction tax. So this is most important to investors and traders. On 23rd July, the Union Budget shocked investors with a rise in LTCG and STCG. So long-term capital gain tax raised it from 10% to 12.5%, which is 25% increase. So this will definitely impact the profits on long-term investment. So you can see, market was down by almost 300 points after this announcement. Short-term capital gain tax increased from 15% to 20%. This is hilarious. I think, this will definitely demotivate the speculators in the market. Both equity speculators and commodity speculators and future and option speculators. Because 20% short-term capital gains is definitely, you can consider a pain for any trader or investors. The security transaction tax in derivatives (F&O) segment raised it from 0.01% to 0.02%. For a long time, SEBI is asking government increase the security transaction tax to curtail F&O participation. I think this is not a major impact. Yeah, it's doubled, but I don't think so. It adds a huge cost to the F&O traders. Instantly, the Nifty is down by more than 300 points. Yeah, overall, a thin increase can impact investors' long-term and short-term profits. Coming to the other important point is revenue expenditure. Revenue expenditure, as I explained earlier, doing this expenditure, there will be no income. So it is not a good sign for economy. But yes, if government is concerned about welfare of the poor people, then they have to expend it. But this has to be moderated well, or else, the economy can go toss. So these are essential parts of the overall budget. They include welfare schemes, state pensions, housing benefits, tax credits, income support for low-income families, child benefits, unemployment benefits, and health benefits. These are not part of GDP and do not reflect as a reward to factor of production for economic activity. As I said, these are not considered in the economic activity. The contribution of 4% to pension, 9% to central sponsored schemes, and 7% to subsidies, petrol subsidies, gas subsidies in the overall budget show the central government's commitment to the welfare and growth of Indian citizens. So we should consider these all are welfare schemes and pensions, central government sponsored schemes. These schemes include midday meals, Pradhan Mantri Gram Sadak Yojana, the umbrella program for the development of minorities, and the Mahatma Gandhi National Rural Employment Guarantee Program. So these are welfare schemes. So these, generally traders and investors, we have to observe, if there is any huge increase in revenue expenditure, then we should consider that, a government is taking populist route, which is not so good for stock markets. Conclusion. To Indian investors, annual budgets show which sectors and industries the Indian government invests significantly. The capital expenditure document of the yearly budget gives a complete picture of these investments. Investors should look for a rise in disposal income by tracking the tax reduction in personal and wealth taxes. Another crucial area is any cut in corporate tax, which significantly impacts investors' profits. If corporate tax is cut in fiscal policy, it can be considered a boon for other investors. Other parameters like LTCG, STCG and STT also significantly impact investors' post-tax profits. Unfortunately, this time, LTCG has, touched and STCG also touched, which is not a good part from the finance ministry because already traders and investors are paying STT. So it does, it doesn't make sense again paying LTCG and STCG. Too much tax is applicable on profits and transactions. So yeah, overall, these are the areas, these are the key parameters, investors and traders should look in the union budget so that, they can take advantage of making profits. Particularly the key area is capital expenditure. And the other area is the policies which will boost the private capital expenditure as well. I hope you all enjoyed the content. If you like the content, please do like, share and give your valuable feedback in the comment section.